Welcome. My name is Pat Soldano. I am president of Policy and Taxation Group and Family Enterprise USA. Joining me today is Brandon Ramon, who's an attorney with SQUIRE Patent Boggs. We thank you for joining us for this webinar, which will focus on individual tax policies. Brandon, I think it would be helpful for you to begin by providing an overview of the current key individual tax policies we currently have.
I appreciate that, and I'm happy to be here today with everybody from the Policy and Taxation Group and to talk a little bit about the individual tax policies and where we think they may be headed depending upon the outcome of this November 2020 election. So just at a high level, everybody is familiar with the Tax Reform Law of 2017, the Tax Cuts and Jobs Act, or TCJA. I will go through the details of some of these provisions on the individual side of the tax code as I talk about the candidates' positions on the policies, as largely President Trump is supportive of maintaining the current policies and making them permanent. But just at a high level, you'll recall that during tax reform, it was passed through what's called budget reconciliation, which is a procedure that allows the Senate to, instead of requiring the supermajority vote as it normally does, to pass a piece of legislation with a simple majority. As part of that, though, come various restrictions in terms of budget and other policy restrictions. But in terms of the impact that this had on the individual tax provisions, given that the policymakers had to work within a specific budgetary constraint, they decided to make the individual tax policies that were included in tax reform temporary. And so they are all set to expire at the end of 2025. And so right now there's a large debate in terms of whether it makes sense to make them permanent or whether it makes sense to try to make adjustments or repeal certain of those provisions in the next 4 years.
Well, thank you, Brendan. With that as a backdrop, would you please compare President Trump's proposals with Vice President Biden's, and where do they stand on these issues?
Sure, I'm happy to do it. And Pat, as I mentioned earlier, President Trump, he was the president who obviously signed into law the Tax Cuts and Jobs Act. So he is supportive of the individual provisions that it includes, though he'd like to go a little bit further in some respects. And so I think what I'll do is I'll go through about 6 tax policies, kind of the top level highlights that are most likely of interest to our supporters. And then I'll contrast these with President Trump with those positions of Vice President Biden. So the first deals with the individual tax rate. So as I mentioned again, all of these provisions expire as of the end of after 2025. And so under current laws as enacted under tax reform, the high rate is 35%, and that's for individuals making over 207,000 and 415,000 for a couple. While the top rate is 37%, that's 518,000 for individuals, and then couples of over 622,000. But I will mention again, in terms of the policy specifically, President Trump has suggested that beyond this, he'd like to implement a middle class tax cut. Now, that's not really been defined. Largely, that was being kind of discussed in the context of elections, and it was fairly broad. But we don't really have a lot to it yet, but it's something that he's considered doing. And it actually talked about doing through executive action, but it's likely that that will require legislation. Another piece is on capital gains. And that's something obviously that's important to our members in particular in the context of business, of their businesses. But the president has seriously considered implementing a capital gains tax cut rate, which, as you know, long-term capital gains are currently taxed at 20%. He's also discussed working with Treasury and taking executive action to index capital gains to inflation. I think there's some debate there whether that's something that can be done via executive action or whether it will require legislation. I think there was a split even within the administration, but the president would like to see a capital gains tax cut cut to the rate. Finally, in terms of on this slide with regard to itemized deductions, there was some discussion on the Democratic side, and I'll get to that in a moment, about reimposing certain restrictions on itemized deductions. While the president has not really taken a position here publicly, given the policies that were included in Tax Cuts and Jobs Act, we expect that he would oppose any proposal to further limit itemized deductions.
So that's very helpful, Brandon. As we head into this 717th Congress, Could you please assess for us the likelihood that any of these tax proposals would in fact be enacted?
Absolutely, I'm happy to do it. And Pat, as I get there, I just want to finish through a couple, if that's okay with you, a few of the additional proposals from President Trump, and then also go into those with Vice President Biden. And then I think it would make a lot of sense to go through and talk about, how we see these maybe coming into play depending upon the makeup of the Congress, if that's okay with you.
Sure, that works.
In terms of the other three issues that we are going to talk about today on the Republican side with President Trump, you'll recall that there was a 20% deduction for pass-through entities. It's a special way of providing a credit to provide some parity to these pass-throughs S corporations as compared with the corporate tax cut that we saw and that was made permanent in tax reform. And so the president supports making that permanent. Carried interest, again, it's a complicated proposal, but it's income basically flowing to the general partner of a private investment fund, and it's treated in a very specific, odd way on the tax code as capital gains instead of ordinary income. President Trump, interestingly enough, has largely split with the Republicans on this, and he would like to get rid of that, but Republicans have been under pressure from a lot of these hedge fund managers and have largely opposed that. So we'll have to see if there is an opportunity or if there's something done on the carried interest side next year. And then finally, on the payroll tax cut, it's something we've heard a lot about lately in the context of COVID-19. There was a payroll tax cut that was made this year that would be paid back over the course of next year. It's currently a 12.4% tax on taxable amounts, largely used to fund Social Security. But I'll just mention that the president has talked about reducing the tax percentage of the tax. There's questions, again, given that it's used to funding Social Security, where the other revenues would come from to keep that solvent. But he has talked about making a permanent tax cut to that, or potentially taking additional action to issue another temporary payroll tax cut deferral, I should say. So now we're going to shift and talk briefly about Vice President Biden. As I mentioned, on the Democratic side, there was largely opposition and still concerns about the way the Tax Cuts and Jobs Act was drafted and implemented, and they'd like to see the majority, if not all of those provisions, rolled back. As I mentioned, the 37% rate would be increased, and that we'd do a pre-tax reform level of 39.6%, but they would then focus on using that increase in revenue to reduce taxes on low and middle income taxpayers. There's also discussion about a couple of other tax incentives for these low and middle income taxpayers, individuals and families, and that includes an expanded child and dependent tax care credit for $8,000 per child or $16,000 per family, a forgiveness of student loan debt that would not be included in your taxable income, an expanded work opportunity tax credit for military spouses included, additional tax incentives for retirement savings and 401k plans and other types of tax retirement savings vehicles. And then finally, tax credits for small businesses that offer retirement plans to their workers to encourage more businesses to provide these types of savings vehicles to their employees. I mentioned capital gains. Despite the push on the Republican side to cut it, the Democrats included in the Biden proposal would tax capital gains and dividends as ordinary income, so it'd be a rate of 39.6% if things were to return to the pre-tax reform levels. That'd be a pretty significant increase, I would say, just, again, as the long-term capital gains rate is currently 20%, so it would almost double the capital gains rate. And again, we'll talk about this here in a little bit, but in another webinar in terms of the stepped up basis for capital gains, but the Democrats would eliminate that in their proposal. Moving forward to one final slide with a couple of additional points for the Biden campaign. I mentioned itemized deductions, and so the Biden campaign has proposed capping the tax benefit of itemized deductions of 28%. So basically, anybody with a tax rate of higher than 28% would effectively be limited in their itemized deductions. And they'd also include a restoration of the PEAS limitation. That was something that was suspended, as I mentioned, through 2025 as part of tax reform. But basically, every dollar above a threshold, the PEAS limitation reduces the value of itemized deduction by 3 cents. So again, it sort of reduces the amount that taxpayers can deduct over a certain threshold. For the pass-through entities, they would eliminate that 20% deduction that I mentioned earlier that was included in tax reform for these pass-through businesses. I did reference also the carried interest. The Biden campaign is in line with Trump, but not the Republicans in terms of eliminating carried interest. And then finally, the payroll tax cut, they would leave that in place. And as again, I mentioned, there's concerns about the impact that this could have to the Social Security program, and that there's already ongoing concerns about its solvency, even prior to any reductions or elimination of the payroll tax cut. So Pat, going back to your question, if that's okay, just to kind of end, my presentation today, is just kind of, we now see where the presidential candidates are and what their campaigns would do with regard to tax policy. But, it would be helpful from a risk assessment perspective to understand what's actually likely and what's not likely. I think I learned my lesson in 2016 that it's hard to predict these days what the actual outcome of an election will be, despite the polling. But as of today, I think we've got fairly confident that it seems to be headed in a direction of a Democratic-controlled White House, and very possibly Senate. So using that as the kind of assumption here, I would say that we have two scenarios. Again, there could be potentially a status quo, in which case we don't expect that there will be really any tax policy changes, which was the case this Congress. But again, if we look at the more likely scenario with regard to the Democratic sweep, there's definitely a possibility that we could see some tax changes. And I think that will largely depend upon if the Senate is Democrat and the margin by which it is held by the Democrats. So if you look at the Senate, if they did if they were to vote on legislation that was done via a majority, if they were able to get 50 senators, which would mean they'd have to pick up 4 seats, that means it would be a tie. And then if it was a Democratic White House, that means Vice President Harris would come in and vote on legislation. But that said, again, given that narrowness of the line in terms of the party divide, there would be unlikely to be very progressive tax policies passed, because we see people like Joe Manchin and Kyrsten Sinema, who are very moderate Democrats, that I would suggest are very unlikely to support certain of the more progressive tax policies that the Democrats have pushed. I think the larger that gap gets, the more likely it is that we see somewhat progressive tax policies implemented. But again, I think there's going to likely be a potentially small majority for the Democrats if they are able to take control ultimately. And so, again, I think we'll see discussion on advancing the permanency of these individual provisions or making changes to them. And then also some things around the edges. We're dealing with retirement savings and other issues that are potentially able to receive bipartisan support. The only thing that is likely, I would say, is on the corporate tax side of things, which we're not talking about today. But if we do see Democrats take control, I think one of the big first things that they are likely to do is try to increase the corporate rate, though I don't think it will be a substantial increase. So again, I think we're likely to see some attempts to make some changes on the tax policy side of things. But in terms of individual tax cuts, I think we'll have to wait and see for a couple of years, more likely, in terms of what they want to make permanent and which want to be reformed. And that will largely depend upon the makeup of Congress after the November election.
Well, that's very helpful. Thank you, Brandon. I really appreciate your insights into these issues. Trying to understand what's going to evolve with the election is very helpful, and ultimately what kind of tax policy we're going to end up with. And that will have a significant impact on our family-held businesses. So for all of our supporters and our members who participated in this webinar today, we really appreciate your interest. We hope you found it helpful, and we appreciate your support. Thank you. And thank you, Brandon.